Meet Stick, 24 years old in this first scene, 54 by the time we are done. In between those two ages, Stick will deposit, borrow, save, invest, and build a life at the same financial institution from the same opening account. Across 30 years, the bank's logo will not change once. The building he walks into will not change. The brand printed on every statement, every credit card, every loan document will be identical from age 24 to age 54. But the institution itself will become aged completely different banks to stick across that span. It will charge him for being broke. It will ignore him for being ordinary. It will recognize him when he becomes promising. It will pursue him when he becomes valuable. And eventually it will ask his opinion, as a peer, on how to design the products it once told him he did not qualify for. Same logo, same software, same servers. The bank that exists for Stick at 24 is not the bank that exists for Stick at 54. We are going to watch every floor of the institution open and close around him, tier by tier, dollar by dollar, until the whole machine is visible. Start in the basement. Negative balance, age 24. Stick is in his first real job out of school, working at a small office somewhere downtown for an entry-level wage. His checking account holds whatever is left after rent, gas, and the loan payments he never quite finishes. On a Thursday in August, Stick's account holds $35.20. He had canceled his health insurance plan 2 months earlier, when he could no longer afford the premium. The provider's billing system, however, had not yet processed the cancellation. That morning, the next monthly premium pulls from his account anyway. $43.50 against a balance of $35.20. By Saturday morning, Stick walks down to the mailbox in his apartment building hallway and pulls out 3 envelopes from the bank. 3 separate fee notices, mailed on 3 consecutive days. $35, $35, $35. The first fee for the insurance that bounced, the second for a phone bill that auto-charged 26 hours later, hitting an account already in the negative. The third for a streaming service Stick had forgotten about. 3 return transactions, none planned, all automatic, produced $105 in fees from an account that had $35 in it to begin with. The fees together cost more than 3 times Stick's starting balance. He sits on the stairwell of his apartment building reading the letters one by one. He calls the bank from there. He waits 38 minutes on hold. The agent listens, then reads from a script. The fees were assessed in accordance with his account agreement, and at this time are not eligible for reversal. Stick thanks her without meaning to. The fee was not the punishment for being short on cash. The fee was the product the bank was selling to someone in his exact situation. 1 year later, Stick has steady part-time hours plus occasional side income from helping people with small projects on his off days. The hourly wages from his main job are direct deposited, but those wages on their own do not meet the bank's qualifying deposit threshold. So on the first of every month, the same charge keeps appearing on his statement, $12. Account maintenance fee. The footnote reads, fee waived for accounts with a minimum balance of $1,500 or a qualifying monthly direct deposit. Stick has neither, technically. He goes to the branch on a Saturday to ask if his wage direct deposit can qualify by itself. The wait at the branch is 43 minutes. The conversation, once it begins, lasts 90 seconds. The fee is, the teller tells him, automatic, applied by policy, not reversible by request. In that same visit, Stick applies for a credit card. The system offers him a secured card. He would deposit $200 of his own money. The bank would lend it back to him on a parallel account and charge him 27% for the privilege. He reads the offer twice. He does not take it, which means when his bicycle's tire blows on a Tuesday morning that summer, he cannot put the $28 replacement on a piece of plastic. He walks the rest of the way to work that day. He keeps walking for 2 weeks until his next paycheck. 2 years later, Stick has taken a new job, a junior position at a small firm, full-time, salaried. On his first day, in a small HR conference room, he fills out a stack of paperwork, including a direct deposit form for the company's payroll provider. He does not think much about it. His paycheck arrives electronically, twice a month on a regular schedule. The pattern is what changes things, not the amount. 8 months later, on a Wednesday afternoon, Stick is sitting in a coffee shop after work, scrolling through his banking app, killing time before meeting a friend. He notices something. The line item for the $12 monthly maintenance fee, which is bled out of his account every month for the better part of his adult life, is not there. He scrolls back. 3 statements. 4. 6. The fee disappeared in March. Nobody told him. There was no email, no notification. The internal pricing engine had been monitoring his direct deposit pattern for 6 months, decided his account qualified for what banks internally call relationship pricing, and silently moved him to a different fee schedule. This is the most underused lever in retail banking. Most banks waive the maintenance fee the moment a qualifying direct deposit starts hitting your account. Usually, any recurring electronic deposit above a few $100s per cycle. You do not have to ask. You do not have to negotiate. The bank wants the pattern more than it wants the fee. Stick had set up direct deposit on his first day at the new job. The bank had been quietly upgrading him ever since. He puts down his phone, takes a sip of coffee, and gets it now. 3 more years. Stick has been promoted. He has $22,000 across his accounts. He needs to buy a car. He goes to a dealership on a Saturday afternoon. The same dealership, as it turns out, where he had inquired about financing during Tier 2 and been told he did not qualify for a standard auto loan at all. The same finance manager is at the same desk. He pulls Stick's file. The credit profile that 2 years ago could not get an auto loan at all now qualifies for the bank's standard rate, 6.8%. The same finance manager who turned him away at Tier 2 slides a loan offer across the desk at Tier 4, with no irony, because to the finance manager nothing has changed except the number on the screen. He does not remember Stick. Stick remembers him. This is the most consequential lever in the entire ladder. The same loan does not cost the same money depending on which tier you sit on. The same Stick, at the same dealership, with the same financial institution underwriting the deal. 11% at Tier 2, if it had been offered at all. 6.8 at Tier 4. Over a 5-year term on a $25,000 car, that gap is roughly $2,000 in interest, multiplied across every loan Stick will take for the rest of his life. Car loans, a mortgage, eventually business credit, the tier difference becomes a 6-figure number across 30 years. The bank is not punishing Stick at Tier 2. The bank is pricing risk. Risk falls as your tier rises. The same week, Stick receives a message in the bank's secure portal from a senior personal banker named Tanya. She would like to schedule a 15-minute call. He takes it. She does not sell him anything. She asks. 4 more years. Stick has been promoted again. He is now a director-level professional. He has bought a small starter home, gotten married, and started building a real life. His and his partner's combined assets at the institution sit at $110,000. A new label appears on his monthly statement, beneath his name. Premier Client. The bank does not announce it. The bank just changes the envelope. Tanya is no longer his direct contact. Stick is referred to a wealth advisor named Brian, who schedules a meeting at Stick's office. Brian comes in person. The conversation runs slightly over an hour. Brian does not pitch anything. He asks. He asks about Stick's career trajectory, about plans for children, about whether Stick has started thinking seriously about retirement. He leaves a folder of educational materials and a card with a direct line. This is the moment where, internally, every customer crosses an invisible threshold. The bank maintains a number for each account it does not advertise, a relationship value score, projecting the lifetime profit of the account across deposits, loans, products, fees, and referrals. At Tier 2, Stick's number was small. At Tier 5, it crosses a line where keeping him becomes part of someone's quarterly performance objective. The institution starts behaving like a business that cannot afford to lose him. 2 weeks after Brian's visit, Stick's standard credit card auto upgrades, without him applying, to a premium travel rewards card. A pre-approval letter arrives in the mail for an unsecured personal line of credit at $50,000. Available whenever Stick wants it. The bank is courting him now, not aggressively, deliberately, the way an institution behaves when the math on retention has tilted in his favor. 6 more years. Stick has been promoted to a senior executive role. He has invested carefully across the years. He and his partner have a young child. Their combined personal liquid net worth is around $780,000. The bank shifts again. Brian is still in the picture, but a new contact appears, named Anna, whose role is wealth and succession planning. She wants to discuss something Stick has never been asked about: where his money goes if he is unavailable, What tax structures might help his family if something happens? Whether his parents have addressed their estate? Stick, at 40, sitting in his own dining room across from Anna while his daughter does homework at the other end of the table, realizes the bank is now treating his family as part of the relationship, not just his account. A complex transaction comes up at the firm. Stick is buying a partial stake in a colleague's small business, a $120,000 position. At Tier 2, this would have required him to hire his own attorney, his own accountant, and coordinate 3 weeks of paperwork by himself. At Tier 6, the bank assembles the documents. Calls happen between Brian, Anna, Stick's outside CPA, and the seller's counsel. And Stick is looped in only at the points where his signature is genuinely required. The transaction closes in 2 weeks. He did not ask for the orchestration. The orchestration appeared. The cost of friction has been quietly absorbed by the institution, because the institution has decided his time is part of what it is buying when it keeps his assets. 8 more years. Stick left his employer to start his own firm 5 years ago. After a strategic engagement that paid out, his personal liquid net worth jumps to $8.5 million. The label Premier disappears from his statements. There is no new label. Brian and Anna are no longer his contacts. A private banker named Christopher takes over the entire relationship. Christopher's client list is small enough that he carries it in his head. He responds to text messages within 15 minutes regardless of the hour. One Tuesday, walking through the bank's downtown branch on his way to a meeting, Stick notices something he has walked past hundreds of times and never seen. Beyond the rope line where everyone queues, past the wall of teller stations, on the far side of the lobby, there is a glass door with no signage on it. Just a number. Through the glass, a discreet hallway leads to rooms Stick has never been invited into. Tier 6 through 8 of the institution are not on any sign in any bank lobby. They are not on the bank's public website. The bank will not tell you those rooms exist unless your number invites the conversation. Floors 1 through 5 are the floors the bank advertises. Floors 6 through 8 are the floors the bank only opens when your balance asks them to. Stick is now on one of those floors, and the door he walked past for 20 years has, this week, opened for him. A private investment is delivered to him on paper that month, in a leather binder hand-carried by an analyst who flew in to deliver it. Fewer than 70 clients globally see the prospectus. Stick misplaces his card on a business trip overseas, a wallet incident in a hotel room. He calls the bank from the room. The agent recognizes him before he finishes the first sentence and offers same-day courier delivery to the hotel. There is no please verify the last 4 digits. The system recognized him the moment the call connected. 6 more years. Stick's firm is acquired by a strategic buyer. The liquidity event puts his personal net worth at $35 million. The word client still appears on his paperwork, but the word has been emptied of its old meaning. Stick does not have a banker assigned to him anymore. Stick has a small constellation of people. Christopher, now the relationship lead, a credit specialist, a tax officer, and 2 analysts, whose schedules are partially organized around his transactions. None of them work exclusively for him. All of them know who he is without checking a database first. Several of them are reviewed annually on metrics that include the retention of his relationship with the bank. None of them will ever tell him that. The bank will never put it in writing, but the structural reality exists somewhere in a quarterly review. Stick sits, that Wednesday, in the private executive suite on a top floor of the bank's headquarters, a place he could not have walked into at any of the previous 7 tiers, even if he had asked. The bank's regional president flies in to see him. The conversation is technically a client check-in. It is not. It is the bank asking Stick for his read on the markets, on the kinds of businesses he advises, on what its next tier products should look like. His opinion shows up, anonymized, in internal memos that will shape how the bank speaks to clients on every floor below his. 30 years after a slow processing insurance company put his account negative, and the institution that holds his assets charged him $105 he could not get reversed. That same institution is now asking him how it should design its next decade. So what did we watch? Look back at Stick at 24 and Stick at 54 and notice what did not change. He was the same stickman, the same bowler hat, the same simple curve of a mouth, the same thoughtfulness, the same intentionality. The bank's behavior across those 30 years had nothing to do with any of that. The bank was not punishing Stick at Tier 1 for being lazy. The bank was not rewarding Stick at Tier 8 for being smart. The bank was at every single tier, doing exactly the same thing, applying its internal pricing engine, its risk software, its relationship value calculator, and its tier-specific scripts to a number associated with Stick's name. The number changed. Stick did not. And every floor of the institution he just walked through was the bank responding to the number, not to him. The 8 banks Stick experienced were not 8 different institutions. They were one institution showing him 8 different rooms in the same building. Based on a single calculation, it ran continuously across 30 years of statements. Which raises the only question that matters at the end of a video like this. Which room is the bank showing you today? And do you know which trigger would move you into the next one? Stick is at a small coffee shop on a Saturday morning. Sometime in his 50s, across from him sits a younger Stick woman, no bowler hat yet, slightly smaller, holding her own line-drawn phone with a banking app open. She has just gotten her first real job. She is at Tier 1. Stick remembers Tier 1. He tells her 5 things. Call the bank before the second fee hits, and ask for a one-time courtesy reversal. They reverse roughly 3 out of 4 first-time requests, but they will never offer it. Set up the qualifying direct deposit on day 1 of every new job. It is the single highest return move in retail banking, about $180 a year recovered for 10 minutes of setup. Apply for the unsecured card the bank starts offering you once your account history qualifies, and let any old secured card you held age in the background. When the wealth advisor first reaches out, take the meeting. Even if you have nothing to buy that day, the relationship value score grows the moment a relationship exists. And the most important thing, never assume the floor you are standing on is the floor the bank shows everyone. The doors only open when you ask whether they exist. The younger Stick woman nods. She did not have these things on a card. She had them from someone who climbed the building 1 floor at a time and understood, by the end, what every floor was actually doing. This story is composite. The mechanics, the tier markers, the fee structures, and the private banking thresholds are real and current. Exact figures vary by institution. Stick is not a real person. He is, by design, every person watching this. This is not financial advice. Subscribe for one new money story every week. The systems nobody explains. Explained. Stick will see you in the next one.